So in this chapter we'll be discussing about stock market. So you must have seen similar pictures as this in newspapers or elsewhere. Uh, People sitting in front of computers, and some are happy, some are sad. This mostly you must have seen in financial newspapers or even in news in the television. So what are some of your observations on these pictures? So you can see there are a lot of people. These people are called brokers, and they're tracking something on the computers, right? On the computer screens, they seem to be observing some numbers. Most of them seem to be having multiple screens. Some are happy, some are sad. And besides individual screens, there are some giant screens where a lot of information is being displayed, even though you cannot see because there's a still picture, but actually that information is keeps updating and every second. So in TV news at the end, you must have heard, like when they say Sensex is up by so and so points or Nifty is down by so and so points. So what does all this mean? Let us get down to the basics of stock market. What exactly it means. So companies require crores of rupees to start, grow, or invest. To start a new project or for expansion, they need a lot of money. Now there are various ways in which companies can raise money. One, they can approach banks for loans, that we have seen in earlier chapters. Corporate loans, they can approach banks. But there are other avenues also, And the reason why companies go for these other options is bank loans come with a lot of stipulations, because banks stipulate terms and conditions. One repayment has to be made by so and so period, say 5 years or 7 years. So every month installment has to be paid, or every quarter. And there are some terms and conditions. It's restrictive. Another option for companies to raise funds is capital market. Okay. Capital market, we'll see in detail what it is. It means it's a place where companies can also raise funds. It's another option besides banks to raise money. So this is what a company will do. Suppose, say a company requires 100 crores to start a new project. So a company will issue shares, okay? So for the moment, for sake of simplicity, just think of share as a piece of paper. Nothing more than that. Just share is a piece of paper. So the company will announce to the general public that whoever is interested can buy our shares. And one share is priced very low, like 100 rupees, so very small amount, so the common people like you and me can buy. Okay. So to raise 100 crores, how many shares the company should issue? 1 crore shares, because 1 crore, and assume that the value of each share is 100 rupees. So to raise 100 crores, the company has to issue 1 crore shares. So the company will issue 1 crore shares. Then the interested people, whoever wants to buy the shares, will buy the shares. They'll pay 100 rupees, get 1 share. If they want more, say 10 shares, they'll pay 1000 rupees and get back the shares. And company in the process will be raising that 100 crores. Okay. So note that all this is for simplicity. We are skipping a lot of steps here, which we'll discuss in detail later. But at this moment, just for the sake of understanding, remember that share is just a piece of paper. Company is raising money by selling these certificates. So you might ask, what does the public get by buying these shares? Okay, I have paid 100 rupees and got a share. It's just a piece of paper. So what I'm going to get? Why did I buy the share? Okay, so the people who have bought the shares are actually now owners of the company. Okay, maybe they're owning very small percentage. Out of 100 crores, my 100 rupees is a very small share, 0.00%. But still, I am an owner in a small way. Okay, because I've invested money in the company. Similarly, every person who has bought share or multiple shares are owners of the company. See, this is a very important distinction. Okay, when a bank lends money to a company, bank gives loan to a company, say 100 crores. Bank doesn't become an owner. Bank is not an owner. Bank is just a lender. Bank gives loan to the company. The company will be paying periodic interest every month. It will also repay in phases called installments, maybe every month or every quarter, and after a period of time, 5 years, 7 years, the loan gets repaid and the relationship between the bank and the company ceases. There's no question of ownership. Bank is not an owner of the company, okay? But shares are different. When we purchase shares, we are owners of the company in proportion to our shareholding. So if I buy, say 10 crores worth of shares, out of this 100 crores, I bought 10%. It means I have a stake in the company. I'm the owner of the company controlling 10%. Okay, but we won't buy that much amount. We buy only 1 share or 10 shares, 100 shares. But in a small way, to the extent of our investment, we are also owners. That's a very important distinction between loan and shares. Okay, so what happens, because now I'm an owner, I'm entitled to the profit of the company. Say for example, the company has earned 50 crores next year. With this 100 crores, with the 100 crores the company has raised, it has started the project and started manufacturing goods, sold and got profit 50 crores in the next year. Then the company may decide, okay, because we have got profit, we are going to give a dividend out of this 50 crores. Let us declare dividend of 10 crores. So 10 crores will be distributed as, out of this 50 crores profit, 10 crores will be distributed to the shareholders. How many shareholders are there? Because the company has raised 100 crores by selling 100 shares, 100 rupees worth of each share. They are 1 crore shareholders, so 1 crore shares. So because now the company is issuing 10 crore of profit, so each share will now be eligible for a profit of 10 rupees. So on the investment of 100 rupees, there will be a 10% return. So this is called dividend. Now the company may decide to give dividend every year, or sometimes it may skip, depending on, say, that money can be better spent on some other expansion project. That's up to the company. That will be decided in that's up to the company, okay, management. But if the company decides to declare profit, as an owner, I will be entitled to the share of the profits. Okay, so that is the important distinction between a share and the loan. Okay, this is in a very, very stark difference to the bank loan. If a company earns profit, banks will not be entitled out of any part of that profit. Okay, neither the loss. If the company makes loss, it cannot say the bank, we are not going to pay interest or installment. That's not going to happen. Bank, you have to repay the bank loan irrespective of whether you profit or loss. Whereas as a shareholder, if the company gets profit, you will be getting part of the profit. If the company makes loss, well, you will also make loss to the extent of your investment. Okay, in the worst case, you might lose your entire say I have bought one share of 100 rupees. In the worst case, I might lose my entire 100 rupees, but not beyond that. That's why we call it limited liability. As a shareholder, my liability is limited to the extent of my investment, that is 100 rupees. Okay, so the shareholders get dividend every year throughout the life. Okay, but there is no restriction that you have to hold this share forever. I have bought a share 100 rupees. It's not that I have to hold on to this share for throughout my life. I can sell it. Where I will sell it? So there is a place called stock market. Okay, suppose I need urgent money, then I will sell my shares to some other person. So all these buyers and sellers will meet at a place called stock market. Okay, of course all of this happens in online trading, but for simplicity, let us say there is a room called stock market, and I will go and show my share. Whoever, I have shares of so and so company, whoever is anyone interested to buy it. Okay, now the important point is I don't sell to the company. Okay, I'll be selling it to other shareholders or other new investors who are interested in buying the shares. Okay, the place where this happens is called stock market. Now the price at which I sell need not be 100 rupees. It may be more or less. That depends on how much interested are the people in buying the shares of this company. Say for example, the company is doing very well. It's been 1 year since the company started operations. It's doing very well. Now everybody wants to buy the share. So if I go and say who is interested in buying the share, some person will say, give it to me. I will pay not 100 rupees. I'll pay 120 rupees. Some other person will say, I'll give you 130 rupees, and so on. So whoever bids the highest, I'll give my share to the person. I'll sell it. Now the opposite happens if people are not interested in buying the shares. Maybe this company is not doing well. It's incurring losses, or a key executive like CEO who was successful in developing this company has quit, has shifted to another company. Now the public feels that the company will not grow as fast as it did earlier. So now people are not willing to buy the share. So now if I go and say, come on, I want to sell my share for 100 rupees. Anyone interested? Nobody will come. So seeing that, now I will say, okay, nobody is interested, but I need urgent money. I will say, I will lower the price to 80 rupees. Is anybody interested? Okay. So some investor will say, I will buy it at 80 rupees. Some other person will say, I'll just pay you 70. So people will bid at different amounts. So I will sell to the person who offers me the highest. Say some other person is saying, I'm willing to take your share at 85 rupees. So I'll sell it to the person. Okay. So all these transactions, this buying and selling, where it happens is called the stock market. And the share price, at what price I sell and what price people are going to buy, the price will be going on moving up and down due to various reasons. And that is what you've seen in the pictures above. The screens, the computer screens where you've seen earlier, the brokers are watching, is the live prices, the live actual real time prices. The share prices keep moving up and down due to various reasons. Okay, it's not just the performance of the company per se, the overall economic scenario, okay, which we'll discuss later. So on the computer screens, or all companies that are listed on the stock market, there'll be the share prices will be displayed, and as buyers keep selling, sellers and buyers keep bidding, the prices move up and down. So the brokers will keep track of those price movements and make decision whether to hold the shares or sell them. Here timing is most crucial. Say I have, for example, I have a share of Tata Steel, say whose present price is 703 rupees. I sell it and get the 703 rupees. But however, in an hour's time, it's say 11 o'clock now, by 12 o'clock, maybe the price has increased to 750 because people want to buy this share. Maybe that's because the company has at 11:30 declared its financial results for the quarter, and it has posted very good profit. Now people feel the share is really worth more, so they're willing to buy, pay more and get that share. Okay. So because I sold the share at 11 o'clock at 703 rupees, and the results were out at 11:30. Okay, and the price at 12 o'clock has increased to 750. I have lost, okay, because had I held on to the share for one more hour, I would have sold it at 750. So timing is important. Now the reverse could also have happened. Instead of 703, the price could have fallen to 600. Maybe the government has increased the tax rate for steel industry or all steel companies. So Tata Steel will, as part of the steel industry, also will be affected, and people now are not keen to buy this share. Okay, so when to buy and when to sell, it's a timing decision, and that's why there are specialized people called brokers who deal with this, because as an individual you can't keep track of, you can do it, you can do your own trading, but because there's so many companies listed, it's not possible for you to keep track of each and every company, and that's why they are brokers to assist you, but still you can do your own trading. Okay, so basically it's a question of demand and supply. If more people are willing to buy the company's share, if there is more demand for it, the share price will increase. If people are not willing to buy, when the demand is less, the share price will fall. There are more than 5,000 companies whose shares are traded on the Bombay Stock Exchange. By the way, Bombay Stock Exchange is the most popular, number one stock exchange in India. There is another stock exchange called National Stock Exchange. These two are the top two stock exchanges. At BSE, that's the Bombay Stock Exchange, there are more than 5,000 companies whose shares are listed. We call this process listing of shares. So when a company shares are available for trading, it's known as listing. The shares are listed on the stock exchange. Okay, so because there's so many 5,000 companies, it's not really possible for you to keep track of all these companies. So you have to usually approach a broker and you take their suggestions, because they are into this business 24/7. They know which company to track and when to buy, when to sell. I told you timing is very important. These people are experts in that. So usually this trading is done by brokers on behalf of their clients. So now that we have understood the basics, let us see what a stock market is. Okay, so stock exchange is a marketplace where buyers and sellers meet and do transactions of the shares. And the organizer of this meeting place is called a stock exchange, like BSE or NSE, Bombay Stock Exchange and National Stock Exchange. And also a key point here is, because common people are investing their money, government is very much interested here. It wants to protect the people. And therefore there is a body called SEBI, Securities and Exchanges Board of India. This is a regulator. This is the watchdog of the Indian financial market. Okay, this is a regulator of the capital market in India. Okay, above SEBI there is a tribunal, Securities Appellate Tribunal, which hears and disposes appeals against orders passed by SEBI. But you have to remember SEBI very much, right? It's a very important question. And there are some terms in stock markets like bullish and bearish, which you might have heard in newspapers or news. So when someone is saying he's bullish on some stock, it means that he's expecting that price is going to go up. So say I am holding shares of some company, it is trading at 500 now. I expect that tomorrow by in 1 week's time, or the price will go up to 600. So I am bullish on the stock. Whereas if someone says I am bearish on the stock, it means he's expecting that the price of the stock will be coming down. Okay. Again, long and short is one more term which you commonly hear in the area of stock markets. So when you trade a stock to move up, you are long or bullish on that stock, and when you trade a stock to move down, you're short or bearish on that stock. So in this chapter, the questions you need to be prepared are: why do companies issue shares and raise capital instead of taking loans from banks? We discussed that because bank loans are they come with terms and conditions, and the company has to repay them. Okay, company has to repay them. What is meant by shares? We have seen. What do the public get by buying shares? They get part of the profit. They are owners of the company. What is dividend? We've seen. Why do share prices move up and down? The share prices move up and down because of the people's outlook on the share, indirectly on the company. Okay, so if the company, the people perceive that the company is doing well, and the value, the worth of the stock is more, they'll be willing to pay more, and in that case the price will be moving up. Okay, the reverse happens, and the price moves down. So what is the brokerage firm we've seen? What is the stock exchange? What is the full form of SEBI? What is the function of SEBI? It's the regulator, the financial watchdog of the capital market in India. What does it mean when someone says it's bullish or bearish, long and short? All this we have seen. Okay.